one of the things I would do is very much tell people, be careful. Again, it comes back to that separation agreement and how you're dividing and deciding on the different support aspects. Is you want to make sure that there's not an ability to do that. And what I mean by that is you want to choose the way the amounts are being valued based on the full information of the financial statements, not just what that person is taking out of the company every year, because they have the ability to leave it in there so it's not being looked at as their income for the year.
What's up, Core Nation? Welcome to another episode of Coin for Thought. Today we have Kelly Rossier. She's a chartered professional accountant from Ross Professional Corporation. Thank you, Kelly, for being on the show. It's so amazing to have you.
Thank you for having me. It's a pleasure to be here.
Yeah. So today, I really want to go over kind of like Divorce 101 from an accounting perspective and just run through a whole bunch of topics, especially a couple of questions that, you know, maybe both you and I get asked a lot. So, so in the eyes of, you know, the CRA, what is a divorce? What is a marriage?
So it's a legal union of some sort, but it doesn't necessarily have to be, it doesn't have to be that you've actually gone to the courthouse, done the paperwork and all those different aspects. It could even be common law related of a union. So that's one of the things to kind of keep in mind. So when you're changing a status from a tax filing perspective, this could be just from having a common law marriage, if even just 1 year you've been living together.
So if somebody's been living together for 1 year, they're considered common law. So say, for example, if someone wanted to get sort of a cohabitation agreement.
Always a good idea.
Always a good idea. And I'm pro prenups, but you know, they should get it before that 1 year mark.
Definitely. You definitely want to do that because it's only at the 1 year mark that you actually have to start filing as being in a union together.
Accounting plays a huge role when it comes to divorce because there's a lot of stuff going on, especially when you have kids, you have, you know, the support aspect of it. Okay. You know, for yourself and maybe for your children as well. You know, there's businesses that need to be appraised. There's properties that need to be sold. So, you know, from a childcare benefits aspect, you know, what do you think about, you know, how things should be structured, I guess? What should people do when considering you know, getting a divorce and they're thinking about childcare benefits?
Well, the first thing I usually say is make sure you're making some of these decisions before the separation agreement. Don't wait till the actual divorce, because when the divorce itself is actually happening, they always go back to the separation agreement. So that is the most important document. Really, really important to make sure you're dotting all your I's and crossing all your T's. Talk to all the experts at that point in time, because it's set in stone. So the different things to think about is how you want to do, for example, if there's support involved, the division between what's child support and what's spousal support, because they're actually taxed very, very differently. So that's one aspect you want to think about. When it comes to the child support, those are not taxed. When it comes to spousal support, those are taxed. And the same thing goes from a deduction standpoint. So if you're the one actually doing the paying, for you, you're going to want to be on one side of it, and the person who's receiving is going to want to be on the other side of it. So the way to be fair in all of that is when you're coming up with the correct numbers, you always want to tax affect it. So both sides aren't arguing about it, who's going to get the benefit on this side and who's going to get the benefit on that side. So if you're an accountant and you're talking to your accountant and you're talking to the other person's accountant, when lawyers get involved, they start to yell and get back and forth on there and argue about the different aspects. But really, it comes down to what's the true number you're going to pay for tax. And that's why you want to do that. You want to think about that piece because it'll change over the years too, based on what your income is going to be. So you got to think about your long-term projections of over the time you're going to be receiving the support as well.
Right. And, you know, I feel like people shouldn't depend on their support for daily living, right? So you should kind of pretend like that support is really a bonus, because especially when it's coming yearly, things could happen and the structure could really change, right? Depending on what happens. So, and also say, for example, if you get lump sum support, that isn't taxed versus say, for example, if you're getting a monthly support. So, that's also something that I guess is important to consider. But a lot of people say, hey, I'm going to maybe cash out my retirement and maybe pay a support payment in lump sum. And, what are things that they need to consider when they're doing something like that?
Well, you have to think of where the money's coming from and what tax implications that's going to have at that point. Because if you're going to cash in, for example, a retirement plan that you've had in there, there's going to be income that you have to realize in that year. So again, another tax affecting that you want to do.
Right.
So not only from the support aspect, but from where the money's coming from and sourcing from. Because if you're cashing something in, there will be a tax. Your whole taxable income will go up. So this will not only mean thinking about the tax effect of that piece of it, but also your other sources of income, because your tax bracket as a whole goes up.
Mm-hmm. Now, what's the difference between like a chartered accountant and a forensic accountant? And, there's a huge difference in price there too.
There is. The difference is with a forensic accountant, they get very, very minute detail oriented. So a regular accountant is going to look at things more from a higher level. And there's going to be some trust involved with the person who's providing that information to them in order to create whatever documents that they're doing. Mm-hmm. Now, a forensic accountant, they're not trusting anything they receive. They're actually going into the minute details of those different aspects. A lot of times where I see forensic accountants come and get involved in the different aspects is because, for example, maybe somebody, and a lot of times this comes up in divorces because they're not amicable and the two parties are arguing and one doesn't trust the other. So a forensic accountant can really help you out in that different aspect, especially if you're dealing with a person on the other side who's a lot more savvy in that area than you are yourself.
In your experience, I mean, for me, like, based on my experience, forensic accountants have charged people that I've known and my clients anywhere from $75,000 to like $125,000.
Yeah,
right?
It's very, very expensive, very expensive. And it's because they're going into those minute details and basically proving validity of every aspect. Whereas an accountant's not going to be proving the validity of the documents that they're receiving. They're going to be working with the documents they're receiving.
Okay.
That's the difference.
There's a lot of scenarios where someone who, say, for example, as a husband or a wife that was a business owner, they always say, okay, well, they were in, working with their accountant and their accountant was shady and, they were doing a lot of things that were under the table. Describe that kind of accounting where, what makes someone from the outside call an accountant shady?
So it's really the interpretation, I would say, of what somebody calls shady, because with corporations, when you have businesses, you have the ability to do a lot of deferral. So it's not necessarily that you're being shady, but it could be deferring it to a different period. So when it comes to divorce and separation, they can manipulate the numbers between different periods to get them where they want them, when they want them. So that would be what they have the ability to do. But again, it's within tax rules. In my mind, when you would actually call somebody shady is when they're not working within the tax rules and they're starting to do something a little more funky, where, over a couple of years, it should always come back to the same spot when it comes to the income having to be realized at some point in time. But if it doesn't within a couple of years and they're ignoring those tax rules, that's a little different. Yeah. So one of the things I would do is very much tell people, be careful. Again, it comes back to that separation agreement and how you're dividing and deciding on the different support aspects is you want to make sure that there's not an ability to do that. And what I mean by that is you want to choose the way the amounts are being valued based on the full information of the financial statements, not just what that person is taking out of the company every year, because they have the ability to leave it in there. So it's not being looked at as their income for the year.
Yeah. And that's why, during the financial disclosure, they get pretty thorough, right? So they ask for a lot of these documents too. And it's important that people provide these documents. So you have a full understanding of what the actual incomes are. Right?
Yeah, you have to. One of the most important numbers are going to be your retained earnings number, because that is your profit over all the multitude of years. What's available to come out of the business at any point in time based on what's happened up to that period. So when you're valuing it, very important number to have. The other one is what's called their due to shareholder account. That due to shareholder account is the amount of money that comes out of the corporation tax-free at any point in time and doesn't get reported as income. So two really key numbers.
Okay. So it's important really, if someone's looking to get a divorce, to really consult an accountant to say, how is this really going to affect my finances? How, especially if they're business owners, really, where do shareholders play a part in all of this? Say one of the shareholders is getting a divorce. How are the others affected?
So this is interesting because this is something that a lot of people don't think about because the ownership on the corporations may be multitude of people. So it's not as simple as saying, okay, I've got a divorce, so they're not on it anymore. You can't just say that. Some people think that's just, well, doesn't it automatically happen? And it's like, no, it doesn't. You have to actually get rid of the shares. So if they're holding 50% of the shares, you need to be somehow buy them back, or they have to surrender the shares based on if there was some sort of a shareholder agreement originally done. It's going to specifically say how that would happen. If there was never an official legal document for the shareholder, for the shares to be issued, then you would go into, okay, how are we going to do this? And really you'd value what it is. So you'd value what the company is. This is one where you definitely want an accountant to do a valuation on there. There might even be both sides might want to do the valuation to make sure they compare it, because there are different methods to use for that. And based on the multitude of years, because you don't want to look at just 1 year, you want to look at probably about 5 years to really see the trend on there when you're doing the valuation properly, to make sure you're using the right method to value it properly. And then the shares are going to be sold from the one spouse to the other, or surrendered. If it ends up being sold, then we use that valuation, and that gets taken into consideration when it comes to dividing up the different assets. So those shares will become part of that whole division.
Okay.
Based on the value that the company's considered to be worth at that point in time.
Right. How does it work when, how do tax laws and employment laws come into place when, especially when, say, for example, a business owner is divorcing, say, for example, someone who works in the company, and their wife or their husband, they work together and they're an employee, right? So how does that kind of play out? Because now it's tapping into two different things.
Well, it would be pretty much the same kind of thing. Like, you'd still go by the ESA, which is the Employment Standards Act, because the corporation, even though it might be 100% shareholders is one of the spouses versus the other, it's still its own entity. It's not that person. So it's a separate person, basically, when it comes to the law. So it still has to abide by all of those different legal aspects. Now, this is one of those things that would be great if you're planning ahead of time, because you could have some sort of a legal agreement with respect to that, saying, because I'm the spouse of the shareholder, this is the scenario that it would be, and this is what would happen, to protect you way beforehand.
Okay. It's good to know, because like a lot of people, say, for example, if you're working for a company and your husband or your wife owns the company, it's divorce can be so incredibly expensive. And now all of a sudden you're wondering, am I going to have this job? Am I not? Am I going to be laid off from my job? And how is that really going to work? And is that something that could actually happen?
Yeah, well, also think about this different aspect, which is, if that were to happen, then you want to make sure also, or if that's even of risk, you want to make sure that's in the separation agreement too, where there's a caveat to that, which is, in the event that I'm no longer an employee of this corporation, this income needs to be supplemented and will be additional spousal support, right? Something along those lines. So if the job's taken away, then the support goes up because he's still got the business.
Right. So let's talk about capital gains for a second, because there's a lot of people who might have properties that they need to sell. And some of those properties, a lot of them might be getting sold in, say, a year over versus, say, for example, normally they would get sold over a span of many years, right? So all of a sudden now you have a large tax bill at the end of the year because so much is going on. And at the same time, you want to be able to complete your divorce as quick as possible. But then there's a huge liability also to that as well, right?
There is, definitely. So there's capital gains to consider in these different scenarios. So when it comes to actually selling property, so property will include the shares as well. So that's something to think about. So when the shares are actually being done, then those you can use your capital gains exemption if it falls underneath small business shares, which hopefully it does, which is 500,000 of taxable income at the end of the day in the business. And if it does, then you can use a capital gains exemption, which is over 800,000 everybody's got for a lifetime to be able to use to offset that. But it's only for small business shares that you're able to use that exemption for it. Now, if there's other property, which is like actual homes and whatnot, if it's the home that you've been living in together, then this is, and it's the only home you own, this is an easy one. There's no capital gains at all. You'd be using your principal residency exemption to offset that, no tax to pay. Now,
if they're trying to change that now, they're trying to add,
I know, they've been talking about it for years, right?
Yeah.
So there's been talks on the table for years about that aspect, as well as even the capital gains rate of that not only being at 50% value, which it is now, of potentially raising that to 75 or 100%. So that's going to be a tough one that I think they'll always be fought on every time they keep trying to bring it to the table. And that's why it's not changed so far. For as long as I can remember, they've been talking about it.
Right.
Yeah.
So, you have people, they're selling properties and they do really need to speak with an accountant. They do need to really budget what their tax bill is going to be and figure out how to potentially offset that, right? Whether, through RSPs or whatever the case is, but it's something to be cautious about, especially if, say, for example, maybe if you're putting a property on sale towards the end of the year, maybe you want to be able to put it on next year, kind of in the spring, right? And that's
definitely you might want to play between the different years, and that's something really important to understand because your tax brackets all are based on your income levels, and that's your income from all sources. So if you can split that between a multitude of years, sometimes that makes much more sense. Now, if you're going to end up in the highest tax bracket in both years, for example, in that scenario, you actually might want to just do it under the one. Sometimes I tell people, I know it's a lot of a hit at once, but sometimes it's better because at least then next year, when you still have pretty high income, you're not pushing it still into that high tax bracket where all your income's taxed at that high rate. So it really depends on the situation.
Yeah. No, these are all really amazing points. And what would you say, what kind of advice would you give to somebody who's going through a divorce? Say, for example, they haven't seen an accountant. What are a couple of things that you would want to maybe point out for them to know?
Really, the biggest thing is identification. Identify what it is that you have. And not just you personally, but the spouse has as well. Because it's really important to think of all the different aspects. And there's little things that you may not think about. So even outside of just the business, but what about pension plans? And not just the one for the place that they're currently working at, but what about the ones they've been working at for the job before that, the job before that, the job before that? Because all of a sudden, all these different pieces start coming out of the woodwork that may not even have been thought about even by the other person. That you might know. So even if somebody's working for a union, for example, they've got a pension plan there. What if they switch their unions? Well, there's 2 union plans now to think about that might have pieces in there that now need to be valued and taken into play. Then there's also the aspect of the kids. If there's kids involved, what expenses are there for them? So maybe there's a lot of extracurricular activities. I myself have kids who are playing high-level hockey and as well as competitive dance. So 2 very, very expensive things.
Right.
So how are those going to get paid for? How are we agreeing upon expenses related to that? Is it going to be 50-50? And if it is 50-50, how? Are we both paying the person directly? Is it all coming through one person to make sure the bill gets paid? All of those are different little minute details that you want to make sure that you fully understand. The other thing is tax reporting is really important in notifying the government right away once the status changes, because otherwise what you might end up in a situation for is when it comes to like child tax benefits or GST credits, if you receive any of those, all of a sudden you might show up with a bill to repay a whole bunch of those benefits because you were late in notifying them of that status change. And those benefits do change. So in some situations, it might drop. In some situations, it might go up. And it all depends on what your individual situation is. In most scenarios, it usually goes up for the female and it usually goes down for the male. if the male was the one who was collecting it at that point in time. And a lot of that has to do with the fact that you're going in and you're having a discussion with them, and it goes back to the separation agreement. But it's never the same thing for the same person, not the same person, for every person. It's always going to be different for the different scenarios and the different situations. And I couldn't tell you what that amount would be for everybody, because the amount changes based on what your income level is.
Yeah. And, childcare benefit is really, it's calculated based on net, right?
That's right.
Yeah. So net income. So that's key. And also, I believe it's 90 days. If you're separated for 90 days, you need to be able to inform the CRA.
That's right.
Yeah. So
that's right.
Yeah, those are key things, especially, and I understand this about, I understand how important it is to really understand what your assets are, especially if you're trading your assets, right?
Yes.
Because you have all these assets on the table and you might not want to sell them, but you might want to say, okay, like I'll take this, you take that. And sometimes there's tax consequences to that as well.
Absolutely. And you make a really good point there, because you really want to be careful as to how much you're cashing in. So if one person, for example, has the pension plans and the other person doesn't have one, it might not make sense to cash in that pension plan. It might actually make sense to leave that with them, but then instead you take the house. And you kind of divvy it that way, as opposed to trying to sell all these different assets. Because think about if you were going to sell cash in the pension plan, which you never end up with the same value if you're cashing it in early. You're going to go and you're going to sell the house, and you're going to have capital gains to pay on there. You'll have the taxes to pay on the pension side. Now you guys are probably down more than half, because once you're in the highest tax bracket, you're paying the government more than half of what your income is.
Right.
So the CRA is winning, not you. So sell as little as you possibly can is really the advice that I have. And try to do the division based on what each one of you has. So this is where listing out those assets that I mentioned earlier, like really take an inventory of what each one of you has and figure out what you can kind of swap for with each other. But then also make sure they speak with somebody like yourself who can tell them, okay, now realistically, I know you want the house, but you're going to have the house and no cash. How are you going to pay the bills? Right.
Yeah. And a lot of people, they hold on to that matrimonial home, but it's like, you're going to be eating ramen with the lights off. You're not going to be able to really afford to live in this house, because from a cash flow perspective, there's two incomes that have now turned into one, right? And it took two incomes to qualify to buy that home and maintain that home. So, yeah. So
you might be forced, even if you were to get it at the end, like through the division of assets, when the mortgage renewal comes up, where you don't get it anymore.
Right. You may not qualify for it. Right. And that's a huge game changer. Right. And you also have to think about your credit, right? You can qualify not only just from an income standpoint, but also from a credit standpoint. Right.
Absolutely. So that's one of the things to really watch while you're going through a separation. And this is where I see a lot of people actually completely mess up their credit. And it's the most important time to make sure you don't. Cancel the cards. If you're worried about somebody starting to spend money on the cards, cancel the cards so there's no cards to spend the money on. And then
the money's already spent, you pay them off and then let your lawyer know, right? And then all of those expenses will be equalized. Because if you say, oh, well, he spent this much money on our, say, joint Costco card, and then, you're not paying it off, that's a hit to your credit, right?
Absolutely.
Yeah. So can you talk a little bit about notional tax and what it is? Because that is something that's calculated, and lawyers kind of put that in. They calculate it as like 20 or 25 or 30%, depending on, the lawyer, I guess. And they put that in on the disclosure. So can you describe what notional tax is and how that works?
So the notional tax is basically a fill-in for taxes that aren't done yet. Right? So what is that rate? Basically, it's an estimation of what the tax rate would really be and the tax that would be paid on the income going forward. So this comes back to the tax brackets as well. So when the notional amount's coming in there, you want to make sure that it's actually the right number, because a lot of times I see that notional amount is not right. And I've gone back and forth with a lawyer and said, no, your number's not good. Like, that's not realistic. So when you're dividing these assets, you have to be more realistic. Their tax bracket's not really 20%. Their tax bracket's more like 46. So then you want them to make sure they're adjusting it properly so they're not losing out in the end. Otherwise, that's an additional potentially 20-something% that you could be losing out on when you're dividing those assets once that notional piece is put in, because it's the wrong number. So you want to pay attention to each one of those numbers very, very specifically and make sure they're right and realistic to what you actually pay or would be paying.
Yeah, so it's amazing. You can get your accountant to really calculate what your actual notional tax is, and then you can communicate that with your lawyer to kind of put the accurate number on your financial disclosure, right?
Yeah, so exactly. And in most scenarios, well, I would say not even most, in probably all scenarios, asking your accountant to do that calculation and telling your lawyer that the accountant will provide it, it'll be cheaper for you than the lawyer creating one. And it's going to be wrong anyway.
Yes. No,
because they're using their billable time, their billable hourly rates are going to be more than your accountant's hourly rates.
Yeah, totally.
Yeah.
So what are, last bit of takeaways that you have to say to anybody who's kind of going through this, this whole process?
Take a deep breath. Don't rush it. Take your time and do it right, because it's really, really important, because it's the long-term impact that it's going to have on you, and especially when there's kids involved, on them and what you can provide for them moving forward. So it's really important to take the time, get into the details, get the right people involved who have the right answers to make sure that it's done and they're looking out for you. Don't trust the other side's professionals to tell you what's good for you, because they're going to be looking at it from the other angle. I can tell you right now, in every scenario, what I will tell somebody to do, it depends on which side of the fence they're on. Because it's going to be a different effect of what works out better for them. I can tell them what the fair number is. And usually when I run some numbers, I tell them, okay, if I was running this for the other person, these are the numbers I would tell them. I'm running them for you, so these are the numbers I'll tell you. So go in with these numbers, but realistically take this number if you get it. If you can agree to it, and I can tell them the median number that's actually the fair number between both parties.
And it's nice to have that range, because divorce is something that's so emotional, and you want a certain number, but you're not getting a certain number. And it's nice to know what is a realistic number to really, really expect, so you can kind of get your head right.
Yeah. And you know what? And it also depends on the couple that is separating and divorcing, because I've seen some pretty nasty ones happen. And then I see some I see ones where they really care about each other, and neither one of them wants the other one to be ripped off in any sense of the word, and they want them to be okay. So a lot of times I may see people who actually ask me for that middle number. Well, what is the middle number so it's fair on both sides? Okay, well, it's this number. That's the number then you guys should use. And sometimes the client might actually be somebody who I had been doing taxes for multiple years. So I know both sides of them. I know both of them very well. And they actually both will agree, because they're trying to go the amicable way and not hurt each other. They'll actually have me run the numbers for both of them and share the numbers to both of them. And then they can come up with a fair number together. So it really depends on the situation.
I know, like, we share clients together, and I know that you have like such a holistic point of view and in the way that you work and your style. And, I think that that's also so important for people to recognize, like, who is in their court, what are professionals that they're going to need during a divorce. And it's not just a lawyer, right? Yeah, it's not just a lawyer. And there's a lot of ways that you can get a lot of information from other professionals that will help and support you, not just for your process, but also past your process. Creating your new life and, figuring things out and, filing taxes as a single person and figuring out what that's even like, right?
Yeah. And there's projections that can be done in all those different scenarios as well. So like a projected tax return of what it would look like if we were to even redo the tax return that was done the year before. We can do that and say, okay, if you weren't actually together in this year, and this is what your years are going to look like moving forward, this is how it would have changed.
Yeah.
And then they can actually see what that would look like to know what's coming ahead.
Mm. And I think it's important for people to really ask those questions to their accountants, because sometimes accounts are not so chatty and forward with all of this information. They might have it, but it's up to you to be able to inform your accountant that this is something that is happening in your life. And, this is the kind of support you need, and really challenge them in that way.
Yeah, ask. That's the biggest thing. You've got to ask, because I guarantee for anybody who's got an accountant, there's a lot more they can do for them than what they're actually doing. And even myself, I'm like, sometimes if I pick up on something, I'll say something to people, but I also don't want to come across as being salesy either to people, where they feel like I'm trying to always tell them something more than they really want, or they don't have time for it. But if you bring up a topic, I'll start to give you some little hints as to maybe a direction of a conversation you might want to have at some point in time, right? And that's something to maybe ask your accountants every year even. Is there anything else I should really be considering now that you know my situation?
Right.
Then they can continue to go on from there.
Well, Kelly, thank you so much for all this amazing information. Thank you for coming on the show. It was such a pleasure having you.
Oh, thank you for having me. It was great to see you and to speak with you as always.
Yeah. Well, if you'd like to work with Kelly, definitely check out the links below. If you'd like to reach out to her about any divorce question or tax question in general, don't forget to like, subscribe, and hit that notification bell for more videos to come. See you next time. Bye.